and get it started here this morning. We got a lot to cover today. I'm not sure why I didn't play the audio through when I shared my screen. It should have. Maybe I had the settings set wrong, but nonetheless, you got the eye of the tiger and living my life like it's golden. That's right. So we will get kicked off. Looks like we got quite a few people already on. A lot of new faces on here. Welcome, welcome. This team's growing very, very quickly, very rapidly, and new faces on the call every week. This is a Zoom meeting, so unless you're mobile, if you can go ahead and turn on your camera so we can see your smiling, shining faces this morning, go ahead and jump in there and turn on your cameras. I will ask that if you are mobile, don't turn on your camera. I don't have a box of Dramamine big enough to get motion sickness with everybody jostling around or eating your breakfast while you're on the camera. So go ahead and turn up your camera for that if you would. But if you're stationary, go ahead and turn your camera on and join us here real quick. So awesome. Looks like we got a good crowd jumping on here. Can somebody reply to Steve Garrity on the crew app? He's asking for the password. I'm not sure he saw the post, the graphic. If somebody could reply to him real quick so he can jump on, I'd appreciate that. He just put a post in there asking for the password. Awesome. Perfect. Well, we have a solid lineup of information today. We're going to go ahead and get it kicked off. And we're going to start with the leaderboards for last week, but we're also going to cover the leaderboards for last month, for the month of November, and recognize the performance from folks on the team. We had a lot of new writers as well, and we'll cover those. And then we've got a pretty solid lineup of information today. We're going to be talking about different things that you can leverage in order to enable your sales and ability to protect families. Different products, make sure folks are expanding their knowledge and different options of what's available to enhance your arsenal with every client and increase your app count and the ability to protect families. So let's go ahead and get kicked off here. You guys can all hear me okay? Awesome there. Perfect. So let's start off. Let's go ahead and start with last month's leaderboards for the month of November. And we will start off, first of all, I'm going to start off with recognizing all of our new writers. And so last month, we had 6 new writers in the agency. And we'll start with those folks first, right? So we had, first of all, Shayna Ibrahim for 2 apps for $398 direct to Miss Stella Dinwiddie. Miss Erica Dawn Parker, 2 applications for $408.48 direct to myself. Christy French, 1 application for $528 direct to Spencer. Miss Desiree Johnson with 2 apps for $1675 direct to Miss Stella Dinwiddie. Mr. David Willis, 2 applications for $3,498 direct to myself. And the #1 new writer on the team, Miss Jennifer Gray in Lafayette, Louisiana, with 6 applications for $6,376 direct to myself. Great job in your first month there, Miss Jenny. Appreciate you so much and continuing to gain traction. So keep up the good work. There you go. I see you on there. All right. So let's go ahead and start with the other folks on here, and basically we'll start there. At number 11, Miss Natalie Hermit with 7 applications for $7,061, coming in part-time while she was transitioning out of another job. Direct to Mr. Eric Sullivan on my team. Great job there, Natalie. Number 10, Miss Diane Newman with 9 applications for $8,844 direct to Mr. Spencer Cushion. Number 9, Destiny O'Neill with 8 applications, $10,890 direct to Miss Stella Dinwiddie. Terry Myers tied for app count lead for the month, 24 applications, $11,509 direct to Miss Stella Dinwiddie. Great job, Terry. Mr. James McKeon, 9 applications, $12,066 direct to myself. Mr. Dale Menifee, 7 applications, $12,301 in APV, direct to Mr. Chris Menifee. Awesome job there, Dale. And then number 5, Lionel Anderson, continuing with his momentum with 13 applications for $14,767 for the month, direct to myself. Miss Stella Dinwiddie herself, also tied for app count lead at 24 applications for the month, $18,049, direct to Mr. Chris Menifee. At number 3, myself with 18 applications, $22,576 in APB, direct to Mr. Chris Menifee. Number 2, Spencer Kushin, 17 applications, $22,821, direct to Mr. Chris Menifee. And number 1 for the month, great job, Mr. Andy McKinley, 22 applications for $28,554 for the month, direct to Mr. Chris Menifee. So great job there. Awesome. We will, and so collectively for the team, we had 201 applications submitted. So 201 families protected for $209,088 in APB collectively for the team. So great job there. Let me flip over here to the weekly leaderboards for last week. We'll start down in here at number 10, Miss Stephanie Stubbs with 1 application for $733 direct to myself. You had Miss Gracie Cantu with 2 applications for $1,130 direct to myself. Diane Newman, 7 applications for $2,421 direct to Mr. Spencer Kushin. Donna Bates, 5 applications, $3,097 direct to Spencer Kushin. Spencer himself with 4 applications for $3,602 direct to Spencer. Direct to Chris. And then we had Mr. Lionel Anderson with 5 applications, $4,009 direct to myself. Miss Stella Dinwiddie, 5 applications for $5,930 direct to Mr. Chris Menifee. Miss Jennifer Gray, continuing the momentum. Last week, 3 applications, $5,952 for the week, direct to myself. Jenny, great job. Mr. Andy McKinley with the app count lead for the week, 8 applications for $7,509 direct to Chris Menifee. And at the number 1 spot for last week, myself, I had 5 applications for $14,295 for the week last week. Great job. Great job. And 2 of those apps, as you saw on the post I put on Crew, were actually for over $12,000 for a couple in Florida that I've been working with since October on a couple of long-term care policies for them. So we'll be talking about other things like that outside of the norm, just the, a mortgage protection term and whole life stuff to kind of add to what you're doing for clients, to add to your APB and such. But that's one of them, right? So we'll be talking about things like that on today's call, of what you can be doing. So those are the leaderboards for last month and for the week. So for the week, we had 48 applications, 48 families protected for $50,159 for the team collectively. So great job, folks, there on the team overall. And that's the master agency for Chris's, my, and Jeremiah's organization. So great job there. Awesome. So we will move right in because we have a great deal of information to cover. We've got, first up, I'm going to tee up Mr. Chris Menifee. I believe he's going to talk to us a little bit about universal life products, so we have a better understanding. Is that right, Chris? You're going to talk about universal, right? Okay, that's what I thought. So just so we have better understanding about that. Sometimes there's a little confusion and folks don't necessarily kind of understand what that is and how that fits into what we do. So Chris will tee that up. Then I'm going to talk about things like critical advantage, the critical illness coverages, heart attack, cancer, stroke coverage, priority income protection, so disability income options, and even riders on some of the policies, children's whole life, even dental and vision plans that we do. And another option that I think that goes overlooked far too often from a final expense perspective is a product through American Amicable called Family Legacy, which is an actual whole life policy for folks under 50. So if they have some medical concerns and things, they won't qualify for term. A lot of times people think they're stuck out if they're not 50 or over, or sometimes 45 or older with, say, United Home Life to do a final expense. We do have an option through American Amicable, and I want to just talk about that a little bit. Then we're going to have Lionel Anderson come on and talk about some of his success he's had with the GULE products with Mutual of Omaha, and we'll round that out with Mr. James McKeon is going to talk a little bit about some of the success he's had with some of the Foresters products. So with that said, we're going to jump right in because we're going to be wide open throttle all the way through the meeting. I encourage you to get your pens and papers ready. Make sure you have ample, see folks raising their notepads, ample notes from today's call, because there's going to be a lot coming at you fast and furious. This is not going to be a completely immersive deep dive where we're going to go into every granular facet of this. We don't have the time for that on this particular call. But what we want to do is cover the 30,000 foot view in broad strokes, so you can understand the different options, make those notes, and you can then go do your own research, contact the sales support teams at the carriers, educate yourself on those products, and do a little bit more digging so you're more familiar with those and how to present the value proposition to your clients and to leverage that in your day-to-day appointments. Okay, so we will kick off with Mr. Chris Menifee. Thank you for joining us, sir.
All right, good morning. Great to see everybody on, smiling faces. So let's talk a little bit about Universal Life. I know we had I've had some questions about that, and thank you, Andy, for bringing that to the forefront. That is a product that has actually been in the industry for a long time. It's kind of one that we've gotten away from, just kind of as a whole. There's some reasons for that. I'm not going to get into all the reasons, but there are some things about Universal Life that are actually very beneficial, and I'm going to talk a little bit about, kind of when and where to use that. But let's first talk about what is Universal Life. And basically, in the insurance realm, you have two different types of insurance. You have your term insurance, your temporary insurance, and you have whole life or your permanent insurance. And Universal Life does fall in on the permanent side. There are some asterisks there, some catches. We'll talk about that here in a second. But it is a whole life product. It is a flex premium product. So that's kind of one of the first asterisks. Your traditional whole life, and for easy math, you buy $100,000, you pay $100 a month. It's that way until you either stop paying or you croak. I mean, that's it. Universal Life has got a flex premium. We'll break that down here in a second. How does it work? Like whole life, it has a cash accumulation account. Now, the cash accumulation account has an interest rate that is set by the insurance company. So now there's been a lot of talk, and kind of the hot product, and as far as advanced markets goes, is indexed Universal Life. And I'm not going to get into that, but just kind of to differentiate between a traditional UL and an indexed follows what's going on in the market. It's not invested in the market, but it kind of follows the indices. So S&P 500, Janus, there's several different products, and they follow the indexes. So that's what, if the economy goes up, those plans go up. If the economy goes down, they have guarantees in place where you're not going to lose money. The difference with UL is it's a flat rate. It's set by the insurance carrier, that particular carrier. Now, they will have a guarantee built in. So, this is going to be very generalized. It's not going to be specific to a particular company. But let's say it has a guarantee of 2%. That's the lowest that the company can set the rate, but they're paying maybe a 4 or 5% return on the cash accumulation side. Okay, so set by the carrier. As with all insurance, there is what's called an internal cost of insurance. So the actuaries set a cost of insurance internally, and we'll break that down here in a second. The reason that's important is when you talk about the whole life space, a traditional whole life, I said $100,000, $100 a month. Basically, within that premium, it's baked in that at some point the client is going to die, and so the actuaries take that, they factor it into the premium, and that's why it's a set premium for life for a set death benefit. Okay, so with Universal Life, same thing. You have the internal cost of insurance, but that's where we start to, when you're putting these together, you have to really pay attention to how you're quoting these things. And so I mentioned at the beginning, these are a flex premium product, meaning you can pay more or less. So if we take the same scenario, we took $100,000 at $100 a month. Well, that premium is not set in stone. You can actually pay less than that. You could pay more than that. So how is that determined? Well, when you look at a quoter, and typically most quoters are going to be set up very similar, and it's going to have three levels. There's going to be a minimum premium. There's going to be what they call a target premium, and then there's going to be a max premium, or there's other terminologies they use. But basically, minimum, target, and max. What does that mean? Minimum is just what it means. It's the very bare minimum that you can start the policy with. And the problem with the minimum premium is it's not enough to keep that thing going for long term. It's basically going to turn it into something similar to a term policy. Okay. And we'll talk a little bit about why that matters here in a minute. Target premium is what you should be putting in. So if I were started at $100,000 today, I should be putting in this amount of money a month to make sure that, as I get older, it's still going to be there. Because again, coming back to the internal cost of insurance, that is something that has to be paid for. And so that's where target premium is making sure enough money is going into that policy to keep that internal cost of insurance paid. Okay. And then the max premium is basically putting additional money in, and that is actually helping to funnel money into the cash accumulation account. Actually overfunding it, if you want to use those terms and simplify. Okay. So why is it a flex premium? Well, in the quote unquote old days, I mean, you had two options: term, but that was only good for a term or a period of time, 10, 20, 30 years, something like that. But at the end of that, you either to renew, you had to pay an arm and a leg, or you just let it lapse, which is what most term policies do. Less than, I think it's something like less than 2% of term policies will ever pay a death claim. Well, on the other end of the spectrum is the whole life. The problem with that is, especially when you're talking with families that are on tight budgets, that's like buying the Rolls Royce of insurance. That's you're paying max dollar, you're getting max benefit. I mean, it's going to be there for you at some point, but that's problematic for some people on a budget. So enter UL, or Universal Life. That flex premium product allows people the opportunity to have a permanent product, but not be locked into a premium that, if they get in a situation where they need to back off on how much they're putting in, they can do that, and they can catch up. So we could start out at a target premium of $100 a month, and let's say 5 years down the road, financial crisis hits, and they back off and maybe start putting in $75 a month. They give themselves a little bit of a break. But that also means they can now go back and catch up. They can actually, in the future, put more money in and catch back up and keep that policy funded and keep that going. Okay. So with Universal Life, again, what that provides the client is some flexibility. Okay. A couple things that we have to watch out for, though. With flexibility comes traps or dangers. So here's some of the main concerns with Universal Life. Rate fluctuation. So again, I mentioned there's a minimum rate, say for example 2%, but there's also what the company is currently paying, 5%. So you have to pay attention to that when you quote a policy. You have to look at two columns: what's it currently paying, but you also have to look at the guaranteed column, especially if somebody drops back and starts paying the minimum premium. That's not going to be enough money to keep that policy going long term. That's actually basically going to turn it into a term policy. I mean, it's going to elapse at some point. It's going to be underfunded, and that's also another trap of these policies. When you're selling them, you want to make sure that you're conveying to the client, yes, it's a flex premium, but if you ever pay less into it for whatever reason, financial hardship or whatever, you need to catch that back up, or you will have troubles down the road. Okay. And because of coming back to that internal cost of insurance, in other words, that cost of insurance, think of it as inside the policy, it's almost like a term policy that gets more and more expensive every year. So it starts out pretty cheap at young ages, but as they get older, that internal cost of insurance gets higher and higher. Well, there again, if you're at a target premium, that's kind of already baked in. That's factored in. But if you're paying a minimum premium, you're not paying enough to cover that rise of internal cost of insurance. The other thing to think about is one of the things about a universal life, and if you're paying a target premium or even a max premium, that cash accumulation account also helps offset that internal rise in cost of insurance. So there's some money there to make sure that policy doesn't start eating itself, basically, where it'll actually run out of money. And that's a big problem. Just a quick history lesson: when universal life came out, some 30, 40 years ago, interest rates were a lot higher. And that's where a lot of agents got into trouble, is they would run the illustration and it would have a 2% guarantee, but then, rates were 12, 14. And that's how they were selling the policies. Look, Mr. Client, you put this money in $100 a month, and look, in 30 years, you're going to have $150,000 in cash on top of your death benefit. Well, the problem is rates didn't stay that high forever. In fact, they dropped dramatically. And those are some rough, I've been in on those conversations. Those are some rough conversations when you have somebody who is expecting their policy to have a certain amount of money built up, and it's not there. And it's not there because they overquoted the policy. They quoted at 12%, when in reality, it was somewhere between that and 2%. And so the cash accumulation side didn't perform that way. So rate flux, the rate can fluctuate, and that's set by the carrier. And then also the funding issue, that policy, when we sell these, we want to be selling at least at target premium. But when would you not sell at target premium? Or when would you, again, convey that message of flexibility? Well, here's a couple of scenarios where this is a really good fit. Let's say if you have somebody who is a small business owner, and their income goes up and down. They may have a good year, they may have a bad year. Universal life a lot of times can make sense, and the same thing for an index. I mean, it's kind of in the same family. That can make sense for somebody like that, because if they have a bad year, they don't want to give up their insurance coverage, but they also don't want to be stuck paying the same premium, month in, month out, when they can't afford it. So this policy allows them some reprieve by paying less into it. But again, when you're selling that, you want to make sure you convey the message that, yeah, you put less in it for a period of time, but you really at some point need to go back and catch that up. Okay, so people who need a flex premium, either commission salespeople who the incomes go up and down from month to month, year to year, and in business owners. Also a great fit for ULs, and I found this when we're looking at term insurance, and one of the riders on term insurance is return of premium, which is a nice feature. You pay in for your 20, 30 years, and then at the end you get all your premiums back. The problem with return of premium is with most of our carriers, they cut off at age 50. Okay, so what happens if I'm talking to someone at age 51, 52? But we do have a carrier out there, United Home Life, that does offer ROP, but that's really the only option that I can think of off the top of my head that will go above age 50. Universal Life is actually a nice niche product for somebody in that age bracket, in the early to mid 50s, anywhere between that and 60, because if you look at the cash accumulation over a 20-year period, they put in X number of dollars of premium, typically around, and again, if I'm talking to somebody who's 51, 52, if you look 20 years out, in most illustrations that I see right now, and again, this is based on current rate, in 20 years, those folks have a cash accumulation pretty close to what they've put in, within a year or two of that 20-year mark. Okay. So keep in mind, I just saw the note there. Yeah, we do have a couple exceptions on the return of premium. Actually, Diane, and that's a great point. To your point, the Americo CBO is actually a universal life product. So it looks like a term product, but it's actually a universal life product. So the cashback specifically is a universal life product. So yeah, so that's where universal life offers you some flexibility in selling. I've used it. In fact, an example that I had a gentleman who was actually in his upper 60s, maybe around 70. I can't remember exactly. But he was wanting a term product, but he wanted the option to be able to continue holding that insurance if he needed to after 10 to 15 years. He kind of thought he needed it for 10 to 15 years, but he wanted to be able to have the option to keep it past that. Well, here's the problem. I could probably find him a term policy at 10 to 15 year, but if you've ever looked at the renewal tables on a term after that 10 to 15 year, the price skyrockets. I mean, it's astronomical. The nice thing about universal life is it gives them the option. If you set it up properly, if you pay attention to, again, watch the guaranteed side of the ledger, watch the projected side based on the current rates, you can actually set those up very similar to a term where you've got the 10 to 15 years where the guaranteed ledger says this policy is going to be in place. But what that does for them, again, if you have somebody that's paying the minimum premium year after year, they can go back and make up premiums. So let's say I have a client that says, well, I only need insurance for the next 10 years, but I want the option to be able to continue it on. Universal life, that could be a fit. And I'm going to say every case is different. So definitely take time to study and break that down. But universal life is an option because, again, it's a permanent product. So they can actually go back and make up premium and extend out that policy. Maybe they get 10 years down the road and they realize they need additional coverage, but they only need it for another 2 or 3 years. They can actually run that calculation. They can actually call the insurance company and say, hey, how much premium do I need to put in to keep this going for another 2 to 3 to 5 years to 10 years, whatever that is. Okay, so that's the benefit of a universal life. Just be careful with it, guys. Again, pay attention. Minimum premium, target premium, max premium. Obviously, target and above, you should be okay. But really pay attention. And I know Lionel's going to talk here in a minute about the GUL, which is a nice alternative because the G in that is guaranteed. And so that'll be a nice segue into that when he comes up. And I know, Jon Paul, not to get out of order for you here, but keep that in mind as we just had a conversation about universal life. When Lionel talks about GULE and how that relates to the conversation we just had.
Awesome. Thanks, Chris. Yeah. And so when I'm done with my section, I'm going to tee up Lionel for that. And then James is actually going to talk about some of the Foresters options and what those look like as well, to look more specifically at those. So good stuff there. Again, it's just additional information for you to kind of expand your knowledge base and what you can do to provide for clients, right? And I think, one of the points that Lionel and James can cover here in a little bit is that that's really a good tweener option for somebody who's in that middle ground age where a term is not right, maybe in a whole life is not enough face value, right? So it's kind of a combination of those things. So, but I'll let them cover that in detail. So, all right, so I'm actually going to go in here and share my screen. And again, this is not designed to get granular or specific, but to point you in the right direction of things so you can go self-educate and be more aware of these options to provide them for your clients. And so the first thing that I want to tee up here is, and I'm sharing my screen there. I should be able to see that there. All right. So the first thing, you guys can all see that? Good to go? All right. The first thing I want to talk about is a product with American Amicable. It's called Family Legacy. So when we go in here, you log into your portal here. And again, if you're new, this is not going to make sense for you guys because you're not familiar with this. But again, make notes so you can follow up on this later on. But we all know their traditional final expense policies. For the majority of the companies, they start at 50 years old, right? 50 to 80 or 85 years old. And then there are a few that start at 45, like United Home Life and such. But what if we have somebody who's 39 years old, right? And they've got some medical concerns that they don't necessarily qualify for a term product. And we're not going to go fully underwritten, things like that. But you can do a whole life policy. A lot of times I think people are under the impression that, well, if they're not 50, well, there's nothing we can do for them. Well, that's not exactly true. So there are underwriting, I want you to look at the agent guide, obviously do your call to do risk assessments and such like that to verify for each individual client with the carrier. But as you can see here, your Georgia Mail, no tobacco use plan, whereas and from American Amicable's perspective on their final expense for Dignity Solutions, you've got immediate, graded, and ROP, whereas this one is just immediate and return of premium, right? And again, you can look at those things. I'm not going to go into all the specifics of what those things mean and what qualifies for each of those categories. That you can self-educate on. But as you see here, we've got situations where you can go down somebody 38 years old, 29 years old, 27, and do a final expense, a whole life policy for them. And again, it's still capped at $35,000, but you can add a $35,000 accidental death benefit rider to that. So it would end up being 70 in that regard. And in this case, you've got $57 a month for a client that's a whole life policy. Maybe the customer doesn't necessarily fall into the height and weight chart. Somebody's overweight, right? There's a little bit more leniency, in the underwriting guidelines there for the build chart for these things. So this is something you definitely want to look at as an option for those clients who are under the age of 50, who might be looking at a whole life policy that might not qualify for a simplified term and such like that as well. So just an additional arrow in the quiver. Again, you need to check with the underwriting guidelines. You can go in here on American Amicable, basically, and this is just one company. So again, you can do the same thing for your respective carrier that you're going to look at. But if you want to look at information on this, go into order supply. As an example, I can look here on Georgia, and there it is right there. Symmetry's family legacy option. I can pull this up and I can look at everything that I need to find in here. Here's the agent guide. Okay, obviously the application, you can look the questions over. You do an e-app, of course, if you're appointed with them, but if you had to do a paper app the first time. But again, here's your agent guide, and all the carriers have access to this information. You can scroll through here and look at whatever you need to do as far as build charts, medications that would be knockouts and such like that, in addition to whatever else you need to do to call the underwriters to do a specific risk assessment, okay? And again, not to get too granular on each scenario, but I did want to make sure that we are aware of that as an option for our customers, okay? The next thing that I want to talk about is Mutual of Omaha and some of the other things that we do for critical advantage, priority income protection, and even children's whole life products or the dental and vision plans. If you've got your health license, you're able to sell these things. And there's oftentimes, and I'll stop sharing this for just a second here so I can see on the bigger screen. There are a lot of times when I've had clients, when I'm having conversations about mortgage protection or final expense, and they're covered, or there's really no option from the final expense or term product that may be an exact fit for what they're looking to do. And otherwise, you may walk away from that not being able to write a policy or not protecting the family. But there are tons of other things that we can do for people, right? In addition to what we're already writing or instead of, right? There's a lot of times I go in and have conversations to write mortgage protection and then end up doing something additionally like the critical advantage. So we'll talk about some of those products, how to increase your app count, protecting more families, and also being able to increase your APV across the board for everything that you do. And these are all incremental benefits that add up over the course of the month and the year, of course, right? So let me get back in here and share this one more again. This is the quotes for sales professional landing page on Mutual of Omaha. And so let's just talk about critical advantage. okay, as an example. So, matter of fact, let me stop that one because I want to show you this. Sorry, I meant to show you this first. You can call to the carriers and have them send you promotional brochures. They'll send this stuff to you for free. Okay, so this is a brochure here specifically on Critical Advantage and all the specifics and details in there. I've got one here on priority income protection. These are all professionally done by the carrier, and they sent these to me for free. So I can send these to my clients. I take them with me on the appointments and such like that. So you've got this information available not only to self-educate, but to share with your clients as well. So on the Critical Advantage, there's a couple of different ways you can do this here. And basically, this is, you can go in here and select just critical illness, and it covers pretty much every aspect of that, which includes heart attacks, cancers, or strokes, but it also includes things like, you've got, let me go on here, some of the additional, some of the additional medical concerns, like an organ transplant or dementia, or if you run across things that kidney issues and stuff like that, deafness, paralysis, blindness. I found the section I was looking for. So any of those other kinds of things that fall outside of that scope that are just heart attack, cancers, and strokes. So that pretty much covers everything. And as an example here, you've got, let's change this up here to somebody 65 years old. I'm sorry, it caps at it. Let's do it 60. It caps it at 64. So on the critical illness coverage, you're capped at 64. But the benefit on the heart attack, cancer, stroke is you can actually write this up to age 89, as long as they're not 90 years old yet, right? So whereas a lot of final expense products will stop at 85, this is coverage that I write for people that are in their upper 80s on the heart attack, cancer, stroke coverage. And I'll explain to you the difference of what this does. This is a lump sum payment. So it's not a death benefit. It's not paid to the beneficiary if somebody passes away. This actually pays to the insured themselves, say as an example, $50,000. So in other words, if this client were to have some kind of a blindness, heart attack, stroke, cancer, kidney failure, anything of that nature, some form of paralysis, they're going to give them a $50,000 check immediately. And the way that can help you is, say, as an example, if you have a cancer diagnosis. Well, we understand that if someone's got medical coverage, there are certain things that's going to pay for. But let's say you live in Atlanta and you've got to go to Houston to MD Anderson, which is the world's best cancer facility. Medical insurance isn't covering your flights or a hotel for a relative to travel with you, or bills back home that have to be paid, rent, car payments, mortgages, light bills, food 3 times a day while a relative is traveling with you and living in a hotel or something like that, and having to leave their job and have bills back. So the point is, if you had that kind of money available to you, it could help you fight whatever you're dealing with and not be worried about the finances of it. Okay. And that's a 10-year look back on that. So even if somebody had, say, cancer 18 years ago, they'd still qualify for this. If you talk to somebody who's had a cancer or heart attack or stroke, and they've dealt with the finances of battling that, ask them what it might have been like if they had $50,000, sent to them while they were dealing with it, right? It doesn't make their fight any less, but it gives them a lot more money so that they don't have to worry about the money aspect of having to get better, right? So this is a great product. And again, you can write it to 89 years old as long as they're not 90. So in that case, most of us are going to pass away, unfortunately, from a heart attack, stroke, or cancer. That's the big 3. A lot of people are. So the critical illness covers all of those scenarios that you can write up to age 64. But if they're over that, you would just write the heart attack, cancer, or stroke. Now, it is a combination of the 2 or either or. So in that case, for this, a 60-year-old person, and it doesn't identify by gender on this particular one, if I remember correctly. Yep. So say Georgia, 60 years old, critical illness, $50,000. Calculate, that's $246 a month, right? But that's $50,000. If somebody is a little younger and say 48 years old, and they have a family history of heart attack, cancers, or strokes, they may want to make sure they have coverage. That's only $124 a month, but it covers all of those things we talked about. But let's say somebody actually had a stroke 4 years ago. They wouldn't qualify for critical illness coverage, and they wouldn't qualify for the heart attack and stroke coverage. But they could qualify for the cancer coverage alone, because those are separate issues. If they had a heart attack or stroke 4 years ago, they could still get the cancer coverage. And if they did that, that's only $49. Okay. So just to play around with this, when you go in there, familiarize yourself with that. And you could do this here as the rider for heart attack and stroke. So if they're here over 64, but in their maybe 80s, you could do that. And you can change these anywhere from $10,000 to $100,000. Okay. And these are both optional. You can do one or the other. You can select a term, a time frame, but in most situations, it's better, obviously, just to select lifetime, so they're covered on it for their entire life. Okay. The other rider that you can add here is intensive care unit. And what that does is that adds an additional benefit of $250, $500, $750, or $1,000 a day for up to 30 days if they're in ICU. Okay. So I'm not going to run all the numbers. This is something you can go around in here in the sandbox and play with this all you want to. But familiarize yourself with this product. Make sure you understand how you can leverage this with your clients, and be able to add these to your arsenal. Okay. The other thing I wanted to talk about here was the priority income protection. And I'm trying to be mindful of our time, of course. Priority income protection is a disability income product that will provide a specific amount of income to the client for the term that you select, right? You can pick 12, 24, or 36 months. Now, this is a standalone simplified disability income product, and we'll select, say, Georgia here, no tobacco. Let's say the person is 40. The amount of coverage they can get is predicated by their annual income. The max is $4,000 a month. And again, like life insurance, this is tax-free. So in order to be able to have that maximum amount, I believe it's like 65, maybe 60, $70,000. But let's say they make $70,000 or $60,000. You can put that in there. It caps it at 35. So it tells you how much coverage they would be eligible for based on their income. So let's say it's $3,500 a month. They're 40 years old, non-tobacco. Well, here you go. They can get 12 months, 24 month, or 36 month coverage. It starts at $77, $119, and you can see $152, right? And of course, here you would be able to do the e-apps on the other side. There are specific e-apps for these products. This is a standalone disability income product. Again, maybe you get there and they've got all the insurance that they need, but they're more concerned if I get hurt or sick and I'm out of work, I want to make sure I've got enough to cover my mortgage payments for a year or 2 years or whatever, right? Or bills in general. That's where this would come in. You can add riders for disability income on, say, American Amicable, Mutual of Omaha. You can see how to add those and play in. The cap on Mutual of Omaha or on American Amicable is $1,500, and it's a 2-year benefit. Whereas the one for Mutual of Omaha on the Term Life Express, you can do up to $1,800, I believe, or is it $3,000? But you can do 18 months or 30 months on that option. I have to look at that again real quick as a rider here real quick. But you can look at that here. If you select the disability income rider, yeah, it's $3,000 a month for 18 or 30 months as a rider. But what if the client needed $4,000, right? Or if you're doing an American Amicable policy and they needed $2,000, well, you would just do a separate priority income protection policy for $2,000 possibly, right? So again, familiarize yourself with these riders and how you can add to these things, and it adds to the APV, but also gets additional coverages that are important to the client for things that are relevant for them that they're concerned with. Okay. So priority income protection is a standalone disability income product that you can add there for clients, either with term products or other things, but be mindful of the age limit. This, you can only do up to 61 years old as this, but most of the riders on policies have a similar limitation because they would expect that most people in their mid 60s and older are retired or on Social Security. So there's really a lot of, in those cases, not the opportunity for a disability income option, but that's another one that we have access to our to in our arsenal. Okay. We talked about adding the disability income as a rider. The other thing real quick is the waiver of premium on those policies. And I'm flipping back to, as an example, Term Life Express for Mutual of Omaha. That's here as a waiver of premium. What that does is if the client is disabled or out of work, and they are eligible for unemployment benefits, then basically the company will cover the premiums on their policy while they're out, so that the policy doesn't lapse. Okay, that usually only adds a few dollars, but again, that may be important to somebody, and that extra $3 or $4, $6 a month on scale adds to your overall APV, right? So definitely I want you to start adding other options for clients that are important and relevant for folks. The other thing that I don't normally do is I don't normally do a spousal rider, and I don't do children's riders on policies. You're better off just writing a standalone children's whole life policy or writing the spouse on their own policy. Because with most companies, if the husband has a policy and the wife's a rider and he passes away, well, the beneficiary gets paid, but now the wife doesn't have a policy because she never had her own in the first place. She was just a rider on his. And net, it's about the same cost. You're better off getting her own policy while she's young and healthy, because if she develops some kind of medical concern while the other policy was in effect and her husband passed, now she's turning around trying to find life insurance. It can be challenging. The other thing is the children's whole life policy. And again, I know we're going 100 miles an hour, so I apologize, but I'm trying to be mindful of our time. That's why I said, get your pens and paper ready. These are things you can educate yourself on, and watch this video again, the recording, to make sure you're up to speed on how to leverage these things. Children's whole life policy is their own policy for a kid that's very inexpensive, and it is a whole life policy. It does have some cash accumulation to it. So if they're little and it builds up a few $1,000s by the time they go to college and they need some money for books or car repair or something like that, they can take money out of that if they needed it. But the most important aspect of this, and my wife and I did one for our granddaughter when she was 9, before she turned 10 earlier this year for her birthday. And you can do up to $50,000 on this. And obviously it provides a death benefit, which no parent ever wants to think about. But that's if something happens, those services still have to be paid for, right? But more importantly, this provides guaranteed insurability. And what I want you to understand about that is this: if a kid has this policy on them and during their lifetime they develop childhood leukemia, but their parents got this on them when they were a baby, and they're 7 years old, and they go to rehab and therapy and they're completely rehabilitated, they're in remission, they're good to go, and they go on to live a normal life. Well, if that kid never had a life insurance policy, when they're 25 and get married and they have their own baby and buy a house, it's going to be difficult for them to try to find life insurance because they had leukemia when they were a kid. If they had this policy, it's on them for life, and they can increase the face value at several life events during their lifetime to increase the face value, and they just pay the new premium. There's no underwriting, there's no approval. It's guaranteed insurability. So they can increase it themselves and have a policy that's on them for their whole life. Another very cool feature of this is if the parent or the policy owner, grandparent or parent, passes away, it actually covers the premiums on the child's policy until they become an adult. So the policy won't lapse because the owner of the policy parent passed away. So that's built in as a protection as well on this. And it's an easy e-app. It's very inexpensive. And you can end up doing up to 8 kids, if I remember correctly, on one application, but you put them into opt as 8 separate applications. So it increases your app count, but it also increases the cohesiveness of your relationship with your client, because not only are you protecting their mortgage and whatever else you might have done for them, you just help protect their kids. And this is important. Most parents would want to do this for their child if they know about it. But if you don't tell them, they're never going to know. And this is part of your job and the impact you make on people. So present this to clients and let them know of the option and what this can do for them and all those value propositions. And most people are going to want to add this, but the more coverages and more policies a client has, the less likely they are to churn and then to cancel their policies because of the overall protection, the umbrella of coverages you have for their family. So just as an example, do a Georgia, 5 years old, $25,000 face value. That's $10 a month. Okay. If you brought this thing down to say $20,000 as an example, and you can play with the math yourself, that's $8.60. So play around with this. Make sure you're presenting this to clients. in your presentations. Again, educate yourself on this. There's one other one that I want to cover, and I knew we were going to run a little bit over today, but I hope you find value in what we're going to share today. We still got Lionel and James to come up, but I've got one other thing I do want to show you, because it's something that I've added here and there, and it's important. Mutual of Omaha has dental and vision plans. Okay, and so let's put in here, and just as an example, where I'm at here, maybe you talk to a client that's self-employed, or maybe somebody's a contractor, somebody doesn't have health benefits and things. You can sell this. It's and you can look at the specifics between the preferred and protection, the different plans, but the fully comprehensive dental plan through Mutual of Omaha, with the most coverages and the least amount of deductibles and such per se, is $49 a month, and you can add the vision plan to that for $8.28, right? If somebody, say, again, self-employed husband and wife, and they don't have a vision and dental plans, and you're doing disability income and accidental death and, you know, a term product to protect the mortgage, this is just one other thing you can do to help protect this family. And if you have your health license, you can sell this. You do not have to have your health license to sell disability income as a rider on the term products. But most of us on this call have both licenses, right? If you've got your health, you can sell the standalone health products, which all the ones I mentioned to you here, the critical advantage, priority income protection, and the dental and vision plans are. Accidental death as well is considered a health product, like the Mutual of Omaha program that we sell a lot of. That requires your health license also. It falls under that category. But again, I know a lot of information, fast and furious, but hopefully you're making those notes. Go back and watch this later on. But between all of those things that I just covered, there should be several things that you could be able to leverage in your day-to-day appointments with people to walk away with some kind of an application of protection where you might not have been able to do anything, or adding to what you're already doing and incrementally increasing your APV and your ability to protect families as a whole. So with that said, I'm going to punt over here now to Lionel and get him on deck. And Lionel, we can get you to cover yours, maybe 5 or 6 minutes and such like that, as best as possible. And we'll tee up James. We certainly don't want to cut short the value of the information. But Lionel, you with me, buddy?
Yeah, can you guys hear me?
Yeah. Go ahead, buddy.
All right, great. I'm going to keep it real simple and short and sweet because of our time constraints. The GLE, I never used to use this right in the beginning. I'm still pretty new in the industry, but in the beginning, when I was doing my in-home appointments with the clients and I present the term products, I came across a situation where, well, you know what, I need a little bit more coverage than what you're offering. What happens if I live past the 30-year period and I'm still young? I would then jump quickly into the term life answers because I'm looking after my client's interests. But term life answers wasn't really the be all and the end all, because it bit me in the backside in the beginning, because it takes a long time with a fully underwritten to go through the process. And 3 months later, I'm still waiting, on a TLE product. Then I realized, hold on a sec. Yeah, in Florida, we have clients that are 60 years old, mid-60s, or even in their 50s, and they want coverage beyond the 20, 25 year that the term was going to be offering them. And I always had this ace up my sleeve as a plan B. I never put it on the table right in the beginning. I'd offer them term, and if term worked, great. We'd then write a home certainty and we'd go with it. But if I was picking up the vibe that, they wanted more coverage, they wanted to extend past the term years, and they said, hold on a second. Okay, hold on. I'm listening to what your needs are. I understand your concerns. I have a program for you. And I go straight into the GLE. The GLE is fantastic because you can actually determine how long you want the program to go from 80 years old up to age 120 years old. And then all of a sudden the lights went up and they sat up and they said, well, okay, hold on, this is what I want. I don't want my insurance coverage to cease at age 70 years old because I've got great health. I'm going to, hopefully go to age 90. So I would then sit down with them and say, right, okay, this is the program that we have. Now, Why do we purchase guaranteed universal life insurance? Well, as Chris said earlier, it's related to universal life, but it's got a guaranteed, the death benefit is guaranteed as long as the premiums are paid on time and your coverage is active. The coverage isn't tied to an investment. You pay for the life insurance only, just like term insurance. And this is my spiel. I tell them that Mutual of Omaha have actually got this program. It's whole life with term rates. And that's really my big selling point. You want to go beyond the terms, we have this program. Now, the other important thing is that they have an option after 2 years of ownership on this program. They can actually take out a loan on this program. And if, God forbid, something happens, say a month after they've taken the loan out, say the loan was for $10,000, and they do pass, the coverage would be the face value when it was written, less the loan that's still outstanding. So they do have that option. And as I said, the guaranteed coverage can be a maximum of lifetime coverage to age 120 or a minimum of age 80. Last night I wrote a program where the lady on term, she could go to age 80, but she wanted extra years. So we actually went to age 85, and she was happy with that. So we wrote her up last night. The product features, it's got simplified underwriting. It's a quick issue process. And also, if they do miss a premium for whatever reason or two, they have the ability to catch up, missed premium payments as well. Okay. And I think there's something else that I wanted to mention as well. Yeah, all the riders. If you go in, you'll see they have all the options for all the different riders as well. And I found this to be a winner, especially when somebody is, humming and hawing about the whole situation where, you know what, I don't want coverage until I'm 60 years old. I want to go beyond 60 because I'm in great health. Well, okay, here we go. We have the GLE, which would assist you with that. And yeah, and this is what I've been using as my ace up my sleeve. As I say, I don't pull it out right in the beginning. I sell my term. If the term is running away from me and I'm going to lose the deal, I whip it out, and then all of a sudden, bingo, they like what I'm presenting to them. Short and sweet.
There you go. Great stuff, Lionel. I appreciate that. James, are you with me, brother? Mr. McKeon?
Yes, sir. There we go. I'm unmuted now.
All right, there we go. We'll
How you
take
guys
you up
doing?
here to talk a little bit about Foresters, brother. I appreciate you.
Yeah, for sure. Do I need to do I need to share my screen or anything?
Yeah, I mean, it's up to you. If you got something you want to share so folks can see it, sure.
Okay. Let me figure this out here. Hold on. And let me kill that call. One moment. Sorry about that, guys. Let's see. Share screen. Host disabled attendee screen sharing.
Go ahead.
There we go. All right, so I'm gonna go ahead and share my desktop, if you'll forgive me. Let me get this out of the way. I do have some things already pulled up. So for me, one of the things that I've really found some success with lately is, can y'all see my screen okay? Okay. One of the things I've found success with lately is Foresters. For some reason, I don't know what happened. I had a great July, and then August and probably the first half of September over Labor Day, for some reason, I just tanked. I wasn't closing anything or anything else like that. And I thought, well, let me kind of analyze myself, what I'm saying, how I'm presenting it, my tone, things like that. And then I kind of got into saying, let me kind of shake things up for myself a little bit. What is Foresters all about? I think I had gotten an email or something about Smart UL from Foresters. And so, I thought I'd, kind of do some self-education on this. Let me get logged in here for a minute. Move this out of the way. Oh, what's going on? There we go. Let me get this down here out of the way. All right. So, so I kind of played around with it, and, Foresters has actually been really great. I call their support line. I don't know how many of you use Foresters or sold for Foresters, but I called their support line, just asking about a general question on some whole life. And then it kind of transitioned to the Smart UL. And I mean, they spent an hour and a half with me on the phone. So it was great. The guy I was on the phone with really kind of played some scenarios out with me and did a lot of education on that. So, but under the knowledge zone, there's training, things like that, going over all of this. So again, I don't want to kind of get too deep into this, but I do want to kind of explain what I did, and maybe this can help some of you. So a lot of my clients, as well as probably most of you, is probably around that 45 to 65 range where, you always want to try with the term, and if it makes sense, great. And, always talk about other policies and supplement them with child whole life or anything like that to help protect the family. But at the end of the day, if the term life express or home certainty or whatever the case ends up being, a couple $100 a month, I always talk to them about doing something like this. And then we always talk about the first 15, 20, 25 years, 30 years. So we kind of pay attention to sort of the front end of this. This is called Smart UL. It's from Foresters. Let me kind of go back to the homepage if it'll let me here. All right. Well, anyway, you saw where I had actually, there it is. You click on illustrations. I always work from illustrations. And then if you do sell it, you just come back over here and click on eApp. And it's just like Mutual of Omaha, it's iPipeline. So it's really pretty simple. Then so you click on illustrations, this window pops up. We're going to select, for me, we're going to select Texas. And then you just go down here to Smart UL and click on it. Non-med or medical, right? So it's basically fully underwritten or simplified. So non-medical is simplified. We're going to put, just make up a name here. All right. And so we're going to use the most recent example that I had. This guy was 62 years old. And this is why I default to this product, right? So put in the slashes there. We're going to make JP 62 years old. Sorry, bud. So it's going to go to the nearest age, right? So 63. And then right here across the top, guys, you can see death benefit funding. Here's where you can go to put some riders on it. Accidental death, things like that, kind of keeping it simple. Now, depending on their age, it'll be grayed out and it won't let you. Okay, so he's 62, he's over 60, so we won't have any options here. So let's just kind of focus on death benefit and funding. Now, in all honesty, I started my first Foresters, my Smart UL, I sold September 16th. So I'm still learning, but I have sold, I think 1 or 2 GULEs. I sold 2 or 3 IULs. So I'm still kind of learning a little bit about different ways to structure the Smart UL, but and here's how I talk to the clients, right? I say, okay, Mr. Vetter, let's start with the death benefit here. And then we'll go down and we'll take a look at premium. Okay. So let's start here. And I get them talking about, okay, your mortgage was amount of $170,000, but based on our age, at age 62, it's going to kick back, right? The highest it's going to let you go for simplified underwritten is going to be 150. And that's okay. If I have to explain to him that, look, 170 is what we owe now, but that's not what we're going to owe in, say 2, 3, 5 years. Okay. See it updated. It's not going to let you. Okay. Over here to the right, it's going to give you the calculations in real time as you type in here. And that's another thing that I like about it. So let's take this back to 150. Now down here under death benefit option with Smart UL, it actually gives you the option. You can do a level death benefit, or you can do an increasing. And for those of you that don't know, increasing basically takes the cash value plus your death benefit and combines it. So if the homeowner passes away, then they'll get both, not just the death benefit. So I always select increasing, and I explain that to the homeowner, so he understands that I'm looking out for his best interest and his family and things like that. And then we go down here to premium, and I say, I'll explain what this means later, Mr. Vetter, but we're just going to leave this here for right now. Okay, cash value. or cash surrender value. We're just going to leave that alone at the moment, because what I want to do is show you what the cost looks like. Okay. And then I come over here to at a glance. Now it's already given me summary over here, but that's not really what I want the customer to focus on. I want them to understand how we're going to look out for their mortgage in terms of doing a term policy, right? So I'm going to pause right here. Try to stay with me. I know it seems like I'm bouncing around a little bit. So just to give you an apples to apples comparison and why I default to the Smart UL and kind of use that more as a mortgage protection. So he's 62, right? Well, already I can't even do a 20-year term. So the most I can do here is a 15-year term. And then if I were to do term life answers, depending on his health, I could do a 20-year term, but we don't need to go there. So, so here again, it caps me out at 150,000. So at least on the face value, we're apples to apples, but look, I mean, 15 years versus the potential for the rest of your life. And again, we're not talking about the rest of their life. I need them to stay focused on the next 15, 20, 30 years, right? Because again, he's 62. We're not talking about when he's 92. All right. And if I calculate, there he is, $258.99 a month on Term Life Express. So remember that number. So we come back over here to Foresters. We got our death benefit at 150. Increasing death benefit, and we're going to leave the cash surrender value solved. We're going to click on at a glance. Now, can you guys see that, or do I need to zoom in? Are we good? Everybody gets close to their monitor. All right, so the way I explained it to the homeowner is I said, okay, look, there's basically two premium payments, what I like to call a maximum and a minimum. And I use these kind of terms to kind of keep it more layman and instead of talking you know, insurance lingo. So I just say you have sort of your maximum and your minimum. And then I explain what it is. And I say, look, you know, on a piece of paper, I'll draw sort of the pyramid and I'll say, okay, let's say your policy is $200 a month, and I make it easy numbers, right? And I'll say over here is $100 a month. That goes to cover your minimum cost of insurance. That's your bare bones cost of insurance. There's not a lot of extra going towards any cash value or anything like that. Over here is $100, right? That tends to go more towards your cash value growth. And right now, Forrester's Smart UL is growing at 4.3%. That goes up, it goes down, but it's a minimum 2% guarantee. So it's always growing at 2% at a minimum, and right now it's at 4.3. And then I tell them, I said, you're not going to get 4.3% with a savings account or a CD account. So there's not a lot out there that's offering 4.3% in general. I said, so we want to really take advantage of that. And this is really where you get to pick your premium. You get to decide how much you want to pay. And with this particular policy, as opposed to a term policy where it's a flat rate, here's your death benefit for the next 10, 15 years. And at the end of it, especially at age 62, there's no return of premium or anything like that. You know, you spend all that money over the next 15 years, you outlive your mortgage, you're now 80 something years old. It makes it that much harder to get insurance. So I kind of explain all of this so that they understand why I'm going this route. And then I explain the two different options in premium. And I say, you know, Mr. Vetter, look, I'm not really trying to, you know, sell you $812 a month. That's not the goal here. But what I want to do is I'm going to explain why this policy is ideal. And if you look over here, your minimum cost of insurance is $340 a month, right? So if you remember that chart I showed you over here on the piece of paper, and I have it out on the table, or I show them on the screen. Remember, part of your premium is covering the minimum cost of insurance for $150,000 at age 62, right? Now, here's where you get to choose. This is the minimum you can pick, right? But you can actually choose to put just a little bit more in there. And we want to fund this thing to make it make sense, right? Now, look at $812 a month. This is where you fully fund, if that's your premium, this is where we fully fund this product all the way out to age 100. And you can see here, look, at age 100, right? Age 101, it's zero. There's no more premium. You get free insurance. It's like, happy birthday, you're 100 now, you get free insurance, and you maintain that 150. And of course, there's still a little bit of a slight growth over there, but it covers you all the way out to age 100. Now, obviously, we're not necessarily right now talking about, you know, maintaining this policy all the way out to age 100. But wouldn't it be nice to be able to at least cover more than just 15 or 20 years, or sorry, 10 or 15 years, right? So we can get you at least coverage to 20 years or 25. And if you make it all the way out to age 92, you could fully fund this thing all the way out to age 92 and have that coverage that you need. And that would be your choice. Term product, 15 years, you're done. All right. This gives you those options. So now here's where you get to pick. You get to pick somewhere between here, okay, what you think you're comfortable paying. Now, obviously right now, $340 a month is I understand that's a lot of money, but that's for $150,000. But look what happens to your cash value. And this, guys, is really where I start to show them that they don't have to have 150 up front in terms of face value coverage, because depending on how they fund this policy, it's going to take their death benefit plus their cash value, and it's going to equal that mortgage amount that they're looking in terms of coverage, right? How many times have you sold a 20-year policy on a term and said, you know, if their mortgage was 250,000, but you sold them a 200 or 175 or 100, right? So it's the same concept applied here. You don't necessarily need 150,000 in face value, right? Your mortgage is 170. But look what happens right here. Assuming that your mortgage or that your premium payment, Mr. Vetter, is $812 a month. Look what happens in year 4. You're already, or even in year 3, you're at 172,000. So we've now exceeded the amount of mortgage that we were looking to cover in this policy. So let's do this. Let's kind of play around with this a little bit, Mr. Vetter, and try to get that number down a little bit and still get you the coverage you're looking for. Sound fair? So let's close this out. And now, you remember I told you, let's leave this section alone for the moment. Well, let's go ahead and play with that. First, let's go ahead and say, let's just look at 100,000 and see what happens there. And if you look over here, it's calculating. Okay, see, look, $230.95 a month. That's your minimum. It covers your cost of insurance. If you want to fully fund it out to age 100, it's $546 a month, okay? So we're starting to get a little bit more in terms of, you know, if I were to do a term product, remember it was $258. It was basically $260 a month on a 15-year term for $150,000. But over here, I could at the very least do $230,000 for $100,000. But look at my, $230 for $100,000. But then I go and look at my cash value growth. It's not as high. I'm not contributing as much, right? Makes sense. But look what happens in year 15 compared to that term. If I paid $546 a month, and that's just assuming this chart, if I paid $546 a month in year 15, I have almost $90,000 in cash value sitting there. And my total death benefit is now $188,000. And that's on a $100,000 policy. So in reality, I could probably even look at a $75,000 face value, maybe contribute it a little bit more than the minimum of $230,000, right? So this is where you can really start to find that balance with the client, getting their input. I can't tell you how many times I sat this lady probably 3 customers ago. It was right at the end of October, 1st of November. And I showed her the minimum and maximum coverage. She was 58 years old. And then I went and showed her, look, we were talking about being able to contribute, you know, your more than the minimum. So let's say your minimum's $230 a month. Well, in all fairness, if you contributed even just a little bit more. So Mr. Vetter, if you look right here, let's go back. All right. So if you look right here at year 10, you have about $53,000 in cash value sitting in your policy. Okay. And your total is about $150,000, $155,000 in face in death benefit. So if we go back and kind of mix it up a little bit and say, you know what, let's change cash surrender value solve to specific amount. Okay. Let's go ahead and up that 230 to maybe 275, right? So what is that? A difference of maybe 40, 45 bucks. So if you can put just an extra 40, 45 bucks a month onto this policy, look what happens. So your year 15, you're now with 23,000. Your death benefit is now 123,000 on a $100,000 policy. But look here, your minimum cost of insurance is $231. You're contributing $275. Okay. Compare that to a term product where you were already looking at $260. Rather you're in American Amicable or any other carrier, you're going to be right around that $240 to $270 range for his age. So why not take that money, put it into this policy, contribute however much you think you can, and now this particular policy carries you out 25 years, not 15, for the same monthly rate. And there's cash value if, Mr. Vetter, you do end up sick, if you end up in the hospital, or if you lose your job. Now you have a cash surplus sitting in your life insurance policy that you can withdraw from to buy you 2 or 3 months to get you by if you're in an accident, or if you lose your job, or if you're furloughed during these times. So you have this money available to you. Now, it's not recommended that you pull from it, because look what happened whenever we did not fully fund this all the way out to age 100, right? So I explained to the client, I say, look, the more you fund this thing, the higher your cash value grows and the longer your policy covers you, right? So at $275 a month on $100,000, you get 25 years worth of coverage. So if we were to look at this as a 25-year term policy, okay, then you're covered all the way up to age 88. And if something happens, you're good. Now, I also explained to them why the policy starts to dwindle. Okay, so usually around the 7-year mark before the end of the policy is when it starts to go down. So if you look here, the cash value max is about $24,593 in year 17, and then it starts to go down from there. But really what that means, and I say, look, the reason it does that, sir, is, I mean, imagine at age 83, 84 years old, how much cost of it. If you were to do a policy at age 85, not that I would be able to qualify for you, one for you, but could you imagine how much your monthly rate would be if I could get you a 10-year, 15-year term for $100,000 at age, 85? It would be astronomically expensive, right? I said, so what happens with these particular policies with Universal Life is it's basically subsidizing that cost of insurance with the cash value, so your premiums are not as high. But once that cost of insurance exceeds your contribution and cash value growth, that's when it starts to go down to zero, policy lapses, and you're done. And then I say, Mr. Vetter, I said, but the good news about this policy is you can come back depending on your situation. If you're healthy as a horse and you want to let it lapse, you can. If somewhere, say around age 80, you maybe develop some kind of situation of cancer or a health issue or something like that, where you start seeing the writing on the wall over the next 10, 15 years, you could actually increase your contribution, extend the life of the policy for your family, right? So now instead of 275, you can say, you know what? I want to go ahead and increase that to, maybe 300, 320 to continue this policy out to maybe age 92, 94, 95. And that's your option. And with this policy, you have that flexible premium option. You can call your, policy up. You can call your carrier up and say year 10 and say, look, I've lost my job, or I lost my benefits, or I'm not making as much money, and I need to lower my rate. So maybe you can't afford 275. The lowest you can go is 230. And foresters can adjust your premium up and down over the years based on your situation, So you win the lottery and you want to pay more, and let that cash value grow at the 4.3%. So you can look at it as a supplemental savings account. Hello?
Yeah, somebody doesn't have their line muted.
Oh, okay.
We're about to wrap up anyway.
Yeah, we are. I'm almost done. So at the end of the day, I'm looking at this just as a term product, with the option of extending it beyond that what would be a 10, 15 or 20-year term for people between that age 50 and 65, right? Because they're approaching retirement years and things like that. Finances are going to change, retirement or whatever. If they don't retire till 70, fine. But the idea is that this gives them something that somewhere in the middle of this, as they retire, maybe their income drops or whatever the case, that they've got this little nest egg that they've built up over the previous 5, 10, 15 years, so that they have it. Now they go into retirement years, depending on age, health, whatever, they have this little nest egg that gives them sort of a living benefit if something happens. And then if they do pass away, they'll get the cash value plus the death benefit, because I selected option B, which is increasing death benefit. And if they want to extend the life of the policy, they can. If they need to take a withdrawal or reduce their premiums, it'll shorten the life of the policy. And And, you know, you can find that balance between face value, contribution to get the cash value where you want it. And then you'll cover that mortgage that you need coverage and still get that premium covered, you know.
Yep.
Did that just
Awesome.
about confuse everybody?
No worries. Gotcha. Well, great stuff, guys. And I know we went a little bit over on today's call, but we wanted to fit as much information as we could into giving you additional arrows in your quiver, additional information so that you can be more effective in protecting your clients. Right now, not everything that we've shared with you today is something you're going to go out and master. I mean, you know, you're drinking from a fire hose, so to speak, a little bit with all the information. But what I would encourage you to do is from your notes, and when you go back and watch this video again, go in and pick out a couple, 1 or 2, maybe 3 of these things that you want to focus on. Some of them are pretty simple. Some of them are easy. You can do right now to change everything you do in your appointments from this afternoon on, right? They're easy implementations. It's great to add those, and it's relatively easy to do, right? Other ones are a little bit more complex, like the GULEs, or with what James was sharing with the Foresters product and stuff. So it's a little bit more complex, but it's something you can learn, right? As to James's point and to Lionel's point, a few months ago, these are some things that they didn't even know anything about. They spent some time just studying it, getting with the sales support teams at the respective carriers and learning how these things can work, so that you can sit with the clients and have the most impact in helping those families. So work your way in by adding additional options to what you can do for people. And then once you've mastered those, then go on and add a few more things. I mean, this is all part of your learning curve and your journey here. So we're way over on time. We certainly appreciate everybody staying on the call. We hope you've got some value out of this today, and we will get you on and with the rest of your day. I know quite a few of you have appointments on the board for today, including myself. The week's not over. You've got till tonight, midnight, to turn in business for this week's turn in. But again, make sure you're wide open throttle, you know, and don't let Christmas sneak up on you. It's on the 25th of December every year. Okay, so keep the gas on. Go out there, make a difference in folks' lives. We appreciate you all. Hope again that you found value in this, and good luck and good selling. Okay.